Hey there, welcome back to Scripps News Live. I'm Veronica Cruz. Great to see you on this Wednesday. Thank you so much for being with us. Let's get up to speed right now on some of the other major stories that we're tracking for you. So at 2:30 p.m. Eastern, Federal Reserve Chair Jerome Powell will be announcing the central bank's decision on interest rate hikes. Top analysts believing that the Fed will decide to leave them unchanged for the first time in 15 months. Now, their hope is that this is going to help take pressure off the banks, which have slowed lending as interest rates have gone up and the demand for loans has gone down. More economic markers helping make the case for unchanged interest rates. New inflation reports out today. The PPI, or the Producer Price Index, shows us that wholesale prices have dropped 0.3% from April to May. And that follows similar good news in yesterday's CPI report showing consumer prices rose less than economists expected last month, which is a sign that inflation continues to come down. Ted Rossman joins us now live. He is the senior industry analyst for Bankrate. Ted, good to see you. Thank you so much for your time today. So we're all looking forward to the Fed speaking today. That is Jerome Powell, of course, and it's going to take place at 2:30 Eastern. And the question is whether or not interest rates are going to be raised yet again. Where do you fall on this? What are you thinking? Are we going to see another rate hike, or is there going to be a pause?
It's very likely that the Fed will pause today. The bigger question is what happens at the next meeting or maybe the one beyond that. There may be another quarter point hike, let's say in July. There's no doubt, though, that the Fed is definitely close to the end of this rate hiking cycle, if not at the very end. But a pause does not provide immediate relief to borrowers. Credit card rates, for example, are over 20% on average. That's the highest we've ever seen. We don't think that's going to fall anytime soon. Home equity lines of credit, those are at their highest point in about 15 years. Those are over 8% on average. Mortgage rates are closing in on 7%. That's a threshold that we briefly passed last year, but prior to that, it had been more than a decade. And car loan rates are up and other rates as well. So I think that a plateau is not instant relief. It's just not getting worse for borrowers.
So people are feeling the pain, as you described. But what does a pause do? Does a pause mean that consumers will feel even more pain, or does it mean that it's just going to take some time?
It gives the Fed more time to look at incoming data. We have seen, like you mentioned, recent encouraging reports on the Consumer Price Index and the Producer Price Index. Now, we're not where the Fed wants to be, but there's also a lag to the moves that they've already made. So I think that really what they're trying to do here is give the market, the economy, a little time to digest the rapid increases that we've seen. 10 straight interest rate hikes totaling 5 percentage points. They're doing this, of course, to fight inflation, but it's cold comfort for somebody who has a credit card rate that's shot up 5 percentage points, or all of a sudden is looking at a much more expensive HELOC, or having trouble buying a house because prices are up and rates are up. It's one of these all news is local kind of issues. If you're somebody with variable rate debt, which is especially credit cards and home equity lines of credit, that's where you're feeling the pain much more than somebody who, let's say, pays their credit cards in full every month and gets rewards but doesn't have to worry about interest.
So if we hear the announcement and Jerome Powell says, yes, we're going to go ahead and take a pause right here and kind of look at the economic data as it continues to come in, how should consumers be taking this news? I mean, is this a glass half empty or a glass half full scenario?
I think it, too, depends on your personal situation. Like if you have a fixed rate mortgage, a lot of people are locked in at 3 or 4%. So it doesn't really matter that rates are 7 now. And maybe it's an impediment to trading up or moving elsewhere. But, at least if you have fixed rate debt, which is most mortgages, car loans, federal student loans, things like that, at least you're insulated from hikes. The ones that I worry about are credit cards and HELOCs mostly, especially credit cards. The national average is over 20%. You have to make that payoff a priority. So maybe take advantage of any sort of pause, get a 0% balance transfer card, avoid interest for up to 21 months, maybe consider taking on a side hustle or selling stuff you don't need or cutting your expenses. Credit cards are one to watch because those rates are several multiples higher than most other forms of debt.
So when you look at the big picture, where do you think things stand right now? Because I know that going into this, Powell said that he was trying to achieve a soft landing here. So explain what a soft landing would look like, because honestly, it feels as though it's been a pretty bumpy ride so far. How far do we have still to go?
A soft landing is basically when the Fed can bring inflation down without causing a recession, which historically has been a very difficult task to accomplish. People have been talking about a recession for a couple of years now, and it still hasn't arrived. And I actually am pretty upbeat about the fact that inflation is coming down. I mean, yes, we still have room to go, but continued strength in the job market, I think, is a real asset. The unemployment rate is just 3.7%, which is up slightly, but still, it recently hit more than a 50-year low. It doesn't feel great for people because even if you're working and even if your wages are up, inflation has been higher in many cases. But I actually think this soft landing hypothesis is gaining some traction in recent weeks and months. I think another thing that's going on is lapping the big increases from last year because inflation seemingly peaked last summer. So actually just passing that on a year-over-year basis should help. Again, though, it doesn't mean prices are going to roll back to 2019 levels. It just means they'll be growing at a slower rate. But I think despite some of the negativity, the economy and the consumer are hanging in there.
When we take the economy, when the Fed is looking at the economy, you know, as a whole, and Powell is trying to figure out whether or not he wants to raise rates or pause rates, and let's say he does pause them this time around, but then the next meeting he does hike them yet again. How much does the employment picture factor into his decision?
There does seem to be an acknowledgement that the unemployment rate really only has one place to go from here, and that would be up, unfortunately. But that said, a lot of the projections from the Fed and other economists have unemployment going from the mid-threes to maybe the mid-4% range by the end of this year or early next, maybe 5%, maybe 6% in a really downside scenario. I mean, certainly we don't want to minimize the pain associated with anybody losing their job, but I also think it's notable to point out, as Powell does, inflation hurts everybody, so they need to fight this. And we're not talking 10+% unemployment like we saw in early 2020 or back during the financial crisis. It's a delicate balance, to be sure, and I know the Fed is keeping a close eye on it. But what they're trying to avoid is inflation going unchecked and really becoming sticky to the sense that it gets embedded in this wage price spiral. And, you know, as workers, we love to get paid more, but as consumers, we don't want to pay more for the things that we buy. So that's the delicate balance.
All right, Ted Rossman from Bankrate, thank you so much for your time today. And of course, we're all going to be watching very closely, 2:30 p.m. Eastern. Appreciate it.
Sounds good. Thanks.